The BIS concluded in September that the repo spike was not a one-off confluence of random events, but reflected structural and regulatory issues that could lead to a recurrence. I'd like to ask you if you agree with the BIS findings, and given that we're approaching year-end for the markets, will you be taking any extra steps to ensure that funding is available in the repo and FX swaps markets? There was a report yesterday from Credit Suisse suggesting there's a good chance that we will see disruptions, and one of the reasons they put for it is that the Fed is, at this point, buying only T-bills, and the market wants to sell coupons. Do you have any plans to sell coupons?
So I'm going to take a little step back, and I will get to your specific questions on the year-end and on T-bills. So I guess I want to start by stressing that these are very important operational matters, but that are not likely to have any macroeconomic implications. We decided back in January to remain in an ample reserves regime, and that means we will be setting the federal funds rate, the range for the federal funds rate, through our administered rates and not through active management of the level of reserves. We're committed to robustly implementing that framework, as you can see by our actions. And the purpose of all this, let's remember, is to assure that our monetary policy decisions will be transmitted to the federal funds rate, which in turn affects other short-term rates. We have the tools to accomplish that, and we will use them. The purpose of all this is not to eliminate all volatility, particularly in the repo market. So taking you back, as you know, we very gradually allowed the balance sheet to shrink. We slowed that gradual pace by half in March, and then we ended it in July. Meanwhile, we had surveyed all of the banks, and particularly the large banks who hold a lot of the reserves, and said, what's your lowest comfortable level of reserves? We got those numbers, we added them up, we added a buffer, and it came out sort of at a level that was well below when we were in September. And yet, we saw actually in September that the markets acted as though reserves had become scarce. So what had happened was that liquidity, which actually existed, didn't flow into the repo market, and that had effects on the federal funds rate. So the question is, why did that happen? And we've been very carefully looking at the reasons why that might have happened. There are payments issues. There have been a number of supervisory and regulatory issues raised. We're looking carefully at those. We're open to ideas for modifying supervisory and regulatory practice in ways that don't undermine safety and soundness, and a number of ideas are under examination there. To go through it sort of in time, we started off really on September 17th with overnight operations. By October 11th, we had created and put into effect a plan. That plan is in effect. It's working. I think for the last couple of months, repo markets have been functioning well. Short-term rates are stable. Markets are functioning. So you asked about year-end. Temporary upward pressures on short-term money market rates are not unusual around year-end. And both our repo operations and Treasury bill purchases are intended to mitigate the risks that such pressures pose to our control of the federal funds rate. We think that the pressures appear manageable, and we stand ready to adjust the details of our operations as necessary to keep the federal funds rate in the target range. Our strategy has been essentially the key to our strategy is to supply reserves in the near term through both overnight and term repo. And at the same time, we're raising the underlying level of reserves through bill purchases. I'll take that now. We've said bill purchases. We've also said that we were willing to adapt our strategy. We're not at this place, but if it does become appropriate for us to purchase other short-term coupon securities, then we would be prepared to do that if the need arises. So, but we're not in that place. It very much looks like those bill purchases are going well, just according to expectations. I mean, the other thing I'll say is that we're in, very regular contact with market participants all the time. We'll be continuing that, and we're prepared to adjust our tactics. We're focused on year-end as well and prepared to adjust our operations as appropriate.
The follow-up to that would be, where are we with the possibility of a standing repo facility?
So on the standing repo facility, as you know, we've actually had a couple of meetings where we've discussed that. I think the standing repo facility is something that will take some time to evaluate and create the parameters of and put into place.